All right, so let's talk a little bit about the radio station fraud. As you've read in the paper, an alleged fraud at the college radio station was uncovered in late 2013. The state's attorney's office, working on prosecuting the case, asked the college not to publicly discuss this case while they were working on it. So the college respected the law, and we were prevented from talking about this situation publicly. And Tom, Joe, and I think this has been a very hard time period to have to hear so many misstatements come out and not be able to say anything. So tonight, we want to talk about some of the misstatements and correct them. There have been a lot of concerns raised. We have heard, how could the radio station receive a clean audit opinion when there was an alleged fraud? The fraud is equal to 4 times the annual radio station revenues. The college knew about this fraud for 2 years and did nothing. So these are all very good concerns, and based on the information that was out there, if I was in the public and I read these things, I would be concerned too, and I would believe this. Fraud is very serious regardless of the dollar amount. A system of internal controls encompasses the checks and balances that safeguard assets, detect errors, and help to deter fraud. No matter how well designed, internal controls can only provide reasonable assurance, not absolute assurance. Collusion is a frequent way that internal controls are compromised. And for those of you that don't know what collusion is, it means that there can be somebody working with somebody that is committing a fraud. Now, this could be done on purpose. They could be gaining and earning some money, or it could just be that somebody in authority turns a blind eye, or just plain irresponsible actions. Most frauds are uncovered from employee tips. They're not uncovered through audits. In December of 2013, the college identified an alleged fraud at the radio station. The total amount of this alleged fraud was approximately $440,000 and spanned the course of a 16-year period, not 1 year. This means on average, the average impact to annual financial statements was $28,000 to the radio station, or about 1.4% of the annual radio station operating expenses. And for the college operating expenses, this was 0.02%. Okay, so how did we get a clean audit opinion? Okay, the financial audit was just completed when we discovered this, and the financial statements were issued to the college and had not yet been issued publicly. They were going to be issued at the January board meeting. The college notified the auditors of alleged fraud. So now the auditors were faced with a dilemma. They needed to do some due diligence. Was this fraud material to the financial statements? In other words, if somebody was relying on these statements, would they be adversely impacted by this event? So, for instance, say that you were a bank, and say that this was a private institution and the bank had your financial statements. Would this knowledge deter the bank from making that loan? $28,000, 1.3%. In conducting an audit of financial statements, the overall objective of the auditor is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Misstatements are considered material if they, individually or in the aggregate, could reasonably be expected to influence the economic decisions of users made on the basis of these financial statements. Determining materiality is subjective. It's professional judgment by the auditor. A percentage is often applied to a chosen benchmark, such as operating expenses, in determining the materiality. In general, though, materiality thresholds for auditors varies, but generally speaking, most auditors would consider a range of 3 to 5% as material. So why fraud is concerning at any level? On an annual basis, this fraud fell far below the standard auditing materiality thresholds. In other words, the impact this amount had on the annual financials would not materially impact someone relying on these statements. Based on this due diligence, auditors were able to issue a clean opinion. Now, it's interesting to note that the Committee on Sponsoring Organizations of the Treadway Commission, which is an offshoot of the SEC, looked at 347 alleged fraud occurrences investigated by the SEC between January 1998 and December 2007. Of the 223 companies with available auditor information, the research found that the Big Six, 4 firms, they're now 4 now, Big Six to 4, audited 79% of those companies during this period, and virtually all of the firms received unqualified opinions on the last set of fraudulently misstated financial statements. Only one was the opinion qualified. This demonstrates the fact that the materiality threshold goes undetected by both big and small auditors for a variety of reasons, and that if the fraud is not material, financial statements can receive an unqualified opinion. Again, the purpose of an audit does not say that I'm going to say everything 100% is correct, but it's reasonable assurance that it's not material to the user of the financial statements. So that's how we got to a clean audit opinion. And you can say for the college's financial statements as a whole, I don't want to make light of this. $28,000 is very serious money on an average basis to my income and to my friends here and to the taxpayers. But to the college-wide statements, we're talking about $150 million on the operating statements. The fraud, some people have said the fraud is equal to 4 times the annual radio station revenue. So I just went through the revenues with you on the radio station. You see that on average, the radio station annual revenues are $2 million. So 4 times that amount would be $8 million. We are nowhere near that number. We are $440,000, and again, a period of 16 years. So those numbers that are out there are just plain wrong. And as this case becomes prosecuted, these numbers will become part of that, and the public will see that again. The college knew about this fraud for 2 years and did nothing. Wow. If anybody in this room knew about that fraud, shame on you. So I believe Elmhurst College has said that they have contacted the college, and I'm sure they must have. I don't know who they contacted, but I can tell you that wherever that message went, it fell on deaf ears. Okay? It never went forward. As soon as the college did detect the fraud, it acted quickly, started an investigation, and immediately contacted law enforcement. We would have liked to have this case, an indictment done back in January, and it has been very frustrating for all of us. It was said tonight that John Valente got a sweetheart deal from COD. He got a $10,000 payment, severance. It's not severance. By law, we are required to pay an employee vacation pay that they have earned. It doesn't matter if they committed a fraud or a crime. We still are required to pay that employee for the wages earned. So he got a check for vacation pay that he did not take. So it wasn't a severance pay or anything like that. It was a payment that we were required to make by law. This was a very unfortunate situation. And as I said, the alleged fraud started somewhere around 1998, a period of 16 years. A lot of us were not even here at that time. Any good accountant or analyst will tell you, when a fraud takes place over this long a period, these numbers are embedded in the trends. So it's very hard to detect. We did ask many questions. When I came on board in 2010, the state of the college finances were a mess.